the reason for people delaying the home purchase is a commitment to getting invested earlier in the market, or at least committing some level of funds to investing versus, trying to plop that down on the down payment.
Or the amount of your asset increase if you had invested in the stock market over the last 40 years versus real estate. Real estate, of course, has gone up, but the stock market has done quite a bit better. 18% of D.R. Horton FHA loans were underwater versus 10% of Quicken's loans that did not have those rate buy downs. And
even though the economy added 119,000 jobs, the unemployment rate still ticked up a 0.1% from 4.3 to 4.4%.
Episode 66 of Market Moves with Mark and Jeff, two uninteresting guys talking about interesting times. Jeff, appraisal history is not often talked about or researched, but there was a historic event this week with an appraiser who neither you nor I have met, Adam Winstead out of North Carolina, delivered the very first UAD 3.6 appraisal that reached, I think, Fannie Mae's desk this week.
Yeah, I'm excited for my grandchildren to read about that in the American history books, Mark. I suspect it will go broadly unnoticed or unknown by most people other than those that have been hearing about UAD 3.6 for a decade, and it's now actually delivered. So it's big news in the moment. My guess is that as soon as everybody else gets their hands on or has an opportunity to deliver one, it will be far less exciting. But the day has arrived where it is actually starting to happen. The limited production started in September, but the actual delivery wasn't until November. And as big of a change as this is, I'm not totally surprised that they weren't ready to deliver on the first date of the announced, kind of opening of this thing. But you're right, here we are.
Yeah, it's anxious. I know he's got a couple of press junkets scheduled here, not Market Moves, and we're okay with that, but anxious to listen to Brian Reynolds' podcast. He had teased the interview upcoming. I know some others have him planned. I really appreciate him coming out to talk about his experience and answer some questions on it with lots of curious minds. As far as I understand, there are two software vendors that are able to or have been approved by the GSEs to deliver this stuff. So interested to see where they all came from and all of that. It's coming. And I just listening to the blurb that Brian Reynolds had put out, Adam was like, yeah, I filled out a form. And I thought that was funny and, about the extent of what we do here.
Yeah, that part was fun. And Brian had to peg him like, well, come on, man, you did more than just that. Like, I'm not talking to you for nothing here. Brian's great. He's so entertaining. I wish that I was as dynamic and personable as he is. We'll include a link to that, at least the teaser. That their full episode isn't even up as of you and me sitting down to record today. But he does a great job, definitely entertaining, and it'll be fun to hear the full episode and get some of the behind the scenes details on what it took to make it happen.
It is like a tectonic shift, I think, in appraisal for the next several decades, probably, in how we get all of our information through and into the systems, how loans are analyzed and collaterals analyzed for loans. And so, you get something out there and make it exist first and then iterate. I'm sure we'll have a lot of that. There's been a lot of work coming into this, and we're anxious to dive in as the time comes here.
Yep, absolutely. We shared that graphic a number of episodes back of make it exist even when it's not perfect. The circle that's not like perfectly even enclosed. Illustrated by the Raptor rocket engines. That SpaceX has been generating. Really interesting to see what they started with and the complex jumble and mess versus what it turned into. And we'll see if that's where the 3.6 lands as from an appraisal workflow perspective down the road. But it's at least it started, and now it'll be ramping up and learning as you go forward.
Jeff, on our last episode, we talked a little bit about an article that had come out analyzing the average age of the first-time home buyer in the United States, and it had moved from 29 to 40 years old. I had noted that was a similar trend that I had seen in Canada in a study last year that was talking about that. So interesting to note, major changes. And a lot of reasons or guesses as to why that is. Inaccessibility to homes for first-time buyers is, I think, the default reason everybody goes to, and certainly the default reason that you and I talked about last week. But I came across a Charles Schwab study, and actually a couple of interesting notes. The first interesting note is that Robinhood, that is making investing a little more accessible to people. And I've just sort of been studying the company off and on a little bit over the last while, but the average account size for a Robinhood holder is $12,000. The average account size for a Charles Schwab holder is $300,000. A pretty notable difference. I think definitely serving different customer bases. So notable that we just have some changing trends out there. And I think by account size alone could probably infer that Robinhood is addressing that market that maybe wasn't investing or couldn't invest. Maybe it wasn't accessible to most of the users out there or citizens out there. But the Charles Schwab article noted by generation, the baby boomers, Gen X, millennials, and Gen Z, the average age that they started investing. And I thought that was an interesting analysis, and one I haven't heard things partitioned that way. But for baby boomers, Jeff, that is born between 46 and 64. The average age of the first investment was 35. For Gen X, that is 1965 through 1980. The average age is 32. So gone down 3 years, people getting into investment a little earlier. Millennials born between 1981 and 1996, the average age was 25. And then Gen Z, 1997 to 2012. Most of those folks can't vote yet, if my math is correct, Jeff. But 19 is the average age of investment there. So that alone, I think, is really interesting to see that the average age of people starting to invest is much lower. That's a really good thing, given compound interest and all. But when you juxtapose that up against what we talked about last week, which is the average age of the homeowner increasing from 29 to 40, most think that the largest and best investment somebody can make is their home. I think that maybe our default assessment is different. We might have a shift in habit or psychology of the typical citizen out there. What do you read from this difference?
Yeah, boy, actually a lot of thoughts come to mind, Mark, and one that I hadn't really thought about until you just described that. If you think about from an investment perspective what a typical mortgage is, if you thought about just investing that in your Robinhood account or whatever, over a 30-year lifespan, what would the value of that account be with monthly investments, compounded over time versus what the value of the home will be with the paid off mortgage. Now, of course, that's not like a true apples to apples comparison, because you're not using your investment account as the roof over your head and like the shelter that you need. You're going to have a housing expense one way or the other. So I'm not saying you shouldn't be paying a mortgage, but from a pure investment perspective, it's an interesting idea that I think you've hit on here, that maybe some of the reason for people delaying the home purchase is a commitment to getting invested earlier in the market, or at least committing some level of funds to investing versus, trying to plop that down on the down payment. Now, no doubt that housing affordability is a significant limitation, but I think this is a really interesting juxtaposition of the average age of the home buyer going up dramatically while the average age of the investor reducing, almost proportionately, on that end. I did have to note, though, too, interesting that this article, I think you said, was from Schwab. It sounds like maybe trying to flex a little bit on the disruptor of Robinhood. Like, hey, our average account size is 300,000. I don't know what those guys are doing. My guess is they may be up for some disruption here before too long, or it's probably undergoing now. But really, really interesting perspective so far.
Yeah, I think you could probably put a trend alongside this of just less children being born in the United States, the less, average number of kids per household down. It's not a faux pas, but it's certainly waiting longer in life to have kids, if you have them at all. And a reasonable pathway forward not having kids seems to be more mainstream than it's been in the past. And, speaking from personal experience, I mean, there is a level of stability that I require to provide for my household because I have kids. And if I don't have kids, I don't feel that. And in fact, I have a lot more flexibility and freedom to kind of take advantage of the Airbnb, world or era where you can sort of bounce around and experience a lot of life. So, or a lot of different environments, I guess. But so I think, there's just a lot changing here. We absolutely need to make homeownership more accessible. And I think that trend could be shifting a little bit with, having families younger and that sort of thing, like the pendulum swinging the other way. But it may not just be home affordability.
Yeah, I think that's one of the key or primary takeaway is it's probably a culmination of factors. But, to your point, though, when the decision is to delay, till later in life, whether it's getting married, having kids, buying the first home, it does open the door for the ability to, start an investment account earlier on, even if it's a smaller amount, like we, talked about the differences between Robinhood versus, the Schwab average, account size. But there are a number of reasons that may be. One other, and it's probably minor, but one other thing I've just noted, and I'm curious if your kids have seen the same thing. But for our kids, each of them have had to take in middle school and or high school like a financial literacy class, and I've had my kids asking about like investing, starting an investment or a retirement account. What could that look like? And I've actually delayed, but need to follow up with one of my daughters who wants to start something, and it's just starting small, but she's 16, almost 17, and looking at getting started there. And that has nothing. I mean, she's certainly not a potential home, first-time home buyer, not looking to have kids anytime soon. As if I have anything to say about it, she's certainly not going to, at least in the next couple of years for sure. But but I wonder too, is there a focus on financial literacy earlier on in life? I might have had a financial, like education course in high school. I don't really remember it if I did. I mean, it was from other sources that I would have picked it up, but I do wonder too if there's maybe a course correction even on the educational side that might be drawing attention to this more either earlier or maybe just more effectively than was done in the past.
Yeah, you bet. That was one of the reasons I've talked about this a couple times on the podcast, but I still am, but was a like faithful listener. I don't do that anymore to Dave Ramsey, and that was in my early 20s, and I was a finance major, and then graduate school real estate finance major, and there was no other education, personal finance education, like what I was kind of getting through him. And I liked that it was a lot against mainstream and risk aversion when I'm very naturally inclined to risk. But you didn't have any of that. And man, all of the discussions, I've talked about this on the podcast too, Jeff, is like, every time someone proudly gets on X or somewhere and proclaims that they have paid off their mortgage, they have no more debt, in the it is sure to bring on thousands of comments of how big of an idiot that person is that paid off a 2, 3, 4% mortgage where they could have invested that back into the market at a higher rate and had an arbitrage. So, I think even that, I wish that we had this, and maybe I can find it in time while recording here, but, a good analysis and chart that I've seen going around recently of the number of or the amount of your asset increase if you had invested in the stock market over the last 40 years versus real estate. Real estate, of course, has gone up, but the stock market has done quite a bit better.
Yeah, for sure. And I mean, this is not obviously intended as investment advice, but having a diversified approach to at a minimum owning the home that you're in, as soon as that becomes feasible or reasonably possible, is generally going to be wise. Now, none of us knows if we're going to live through another housing crash like we did in the last cycle. And when that happened, people got burned. And I talked to people like specifically said, I will never own a home again. This has ruined me financially. And, they got out and decided to stay out permanently, of the housing market. The problem is in the short term that strategy definitely made sense. In the long term, and with this most recent run up in pricing, they've left a lot of money on the table. But to your point, when you look at the percentages, real estate, at least as measured by median home price, is not up as much as stock market generally, and certainly specific stocks. I mean, they can go up by multiples, where it generally has taken decades for real estate to do that.
You bet. Well, Yeah, Jeff, just a quick note on some of the stock prices that you and I are following on this episode. We've got the Fannie Mae stock down at 1048 today. There's been a pullback in the stock market over the last several weeks, so probably something to do there. But we also have Open Door trading at about 640. That was up to $11 when we first started talking about it here, and expected a bit of a pullback. So we're seeing that coming through, and a little bit better than normal understanding, I hope, given our seat in the real estate market here, I guess.
Yeah, you bet. And an interesting side note on that topic, Mark, just of the stock market, there has been a bit of a pullback on tech stocks, specifically, and Nvidia just had their earning call. I think it was yesterday. Very strong reports, very strong guidance. But they had dropped. I don't remember exactly what the percentages were, but it seemed like 6 or 8% or something. I think that their strong, continued strong financial performance is shoring up a little bit of the expectation there. But there are some questions around like the strength of the AI investment bet, in terms of a long-term return. There's no doubt that the technology is here to stay and is evolving rapidly and is going to benefit people broadly. But you certainly will have winners and losers on the individual company level, and subsequently, like from an investment perspective, some will do better than others, investing in that tech. But an interesting pullback because it's just been up and to the right, for quite some time to this point.
I can't remember if we talked about how deeply we talked about AI last week, but Brad Gerstner from the BG2 had interviewed Altman. I know we talked about that a little bit. He was pretty arrogant about some negative numbers that were out there, and some were joking that that interview had created the AI bubble, or concern at least for the AI bubble, bursting the bubble. And I think the Nvidia earnings call yesterday relieves some of those, because boy, are they strong as could be. That AI investment thesis that I saw, and I think you and I have talked about, which is that in the end, all of these AI companies that are AI wrappers or wrappers on large language models are ending up going to get consumed by the big 3 or 4 large language models that are out there. That's kind of what I feel like is going to happen. Elon had agreed with that investment thesis when somebody put it out there, that they're just going to be able to do all this stuff, and it's moving so quickly. Gemini just came out with an update to their LLM, and they're now at the top of the charts in performance all the way through. Google has made a really strong comeback in all of this. So that game of kings we're occasionally following, Jeff, I think is fun to watch. I am slowly incorporating Grok more in my day-to-day. I got a long ways to go. It's helpful. I mean, it is instead of Google, in the 10 blue links kind of searches, but I'm using it nonetheless.
Yeah, you bet. And it's an interesting point too that Google is, and I've heard discussions, 6 to 12 months ago as to how should they make this transition from the 10 blue links and the massive ad business that they have to integrating AI. And you'll notice as you do Google searches, it's basically giving you a Gemini kind of analysis. So you still get the links, but they're slowly transitioning, I think, away from that. And it's this kind of, self-disruption that I think they don't have a choice but to embrace, without getting left behind in the long run. But it's interesting to see these evolve. I saw, that Elon's X.AI had topped the charts for a minute on like performance metrics, just to be, then leapfrogged by Gemini. And it's interesting to see this race, kind of leapfrog itself. But I think, your point of like slowly but intentionally and consistently integrating it into the routine. You did mention last week, I think, asking, Grok about all sorts of interesting topics with the kids on the way to school and that sort of thing. And it's just doing things on purpose to kind of force yourself there, really help you to integrate the technology. And I think both of us look at ourselves and say, yeah, we need to be doing even more than we are. But it's the sort of thing you'll never regret, making the focused intention in, finding new ways to integrate it, to find answers, to utilize it. And I look forward to promises that it can do with the agentic solutions and stuff like that I'm not integrating yet, but know I need to.
Amen to that. Yeah, absolutely. Keep pushing the boundaries on what learning new things, and especially these days, for appraisers out there, UAD 3.6 is a good example of a lot of the major change that's coming one way or another. Well, Jeff, we can jump briefly into mortgage application volume. We've got rates sitting here today at 6.36. So just sort of hovering around, not their lowest, but this kind of new 2-month long lower interest rate cycle that's kind of below the 7% that it was sitting at for so long earlier in the year. We have, as of last week's mortgage applications, were down 5.2% seasonally adjusted from the week before. And we see these sorts of things, but as we head into the Thanksgiving holiday, but it's generally quiet from a macro perspective on the mortgage application side. I'm not sure there's much else to report unless you've got anything from those bullet points, Jeff. But we are in a historically low mortgage application period and seasonally adjusted lower period last week than the week before.
Yeah, I'd probably not much more to add to that, Mark. I did see an updated output, that Freddie Mac puts out in terms of mortgage volume, and it's an interesting analysis that they do because they track purchase volume, refinance volume, which gives you the total number of applications, and then overlaid on that, and for anybody watching on YouTube, you can see, on the screen, there's this unique number of appraiser licenses with the desire is to capture what's the appraiser capacity relative or quantity relative to the number of mortgages, being completed. And it is just interesting analysis there that emphasizes this point of, since rates really started to spike, coming into 2023, that the volume is way down and has been down for 3 years. I mean, kind of holding steady at this historically low level. It was, there were far more mortgage transactions taking place in 2016, 17, 18, 19. I mean, forget about COVID era 2% interest rates. Even in a more normal market then, volumes were much higher than they are today. And there were more appraiser licenses back at that point as well, but you were in a rough state of equilibrium. But right now, your appraiser licenses are still, well above the mortgage volume that's been taking place the last couple of years. And so just, I think, a graphical representation of the numbers that you cited most recently, that it's just slow. It's been slow for a long time. And, the only other thing I had to share on that front was my wife and I went on a trip fairly recently. I'd never been to Philadelphia. We ended up there, of course, had to go and do the iconic, Rocky steps and statue and stuff. And the quote that's engraven on there, it really resonates. I think certainly it's true of real estate and surviving these last few years. But Mark, we've talked about this in the past too. It's very true of starting a business, of trying to do anything disruptive, or really even just competing in a market. It's easy to look at those that are successful and assume that they just, started that way or had the magic recipe to get there. And in my experience, and maybe I'm just not the brightest bulb in the box, which is probably a safe bet, but it takes a lot of grit and perseverance to get there. The quote, on the statue is that, it's not how hard you hit, it's how hard you can get hit and keep moving forward. That's how winning is done. And you learn, you iterate, you absorb the hits, and you just keep moving forward and hope to survive it. Not every business that started survives by a long shot. In fact, statistically, you're far more likely to go out of business than to be successful over a 5 or a 10-year time horizon. And so, this quote and just that experience, I think, resonated with me a little bit with, moving into now 3 years of just historically low volumes and scratching to try to, survive and get by. And, congratulations to all those that are. I mean, these types of lean periods definitely have a sorting effect on those that make it and survive versus those that don't. But it hits home. It hits a little too close to home, I think, at times, seeing the numbers of it's still really tough out there, and you just keep moving forward anyway as best you can.
Yeah, all of these times for sure filter out the waste and the fat in what we all do in what we're doing. And so I think there is a natural cleansing that happens not just in business, but all of life that can kind of lead you to that, whether you wanted it or not, whether you thought it was a good idea or not. It just sort of pushes you in those directions. And you come out stronger as long as you keep moving forward. So a great quote, Jeff. And in those appraiser volumes and number of appraisers that are out there, we've got this UAD 3.6 thing. We've got these appraisal waiver things that that are on the horizon here, and what impacts do those have on volume, even when the markets return? We don't fully know yet. It's just a lot of conflicting currents, at least as I see. And I think nobody really knows which ways each current is going to go and with what strength. But, could we end up with lower appraisal volumes generally because of things like waivers or inspection-based waivers? Sure. But could we also end up with a meaningful dip in the number of appraisers, active appraiser licenses completing assignments? Sure, we could, and so maybe the net of available assignments per appraiser goes up. I don't know. It could go a lot of different ways. So we're here watching and affecting this to the extent we can, but in large part it's coming at us, and we just need to be nimble.
They're really good points for sure. And, you've got other currents like an effort by the government to try to remove Fannie and Freddie from conservatorship. And that probably results in them having more autonomy to make decisions around, how often appraisal waivers are granted, and that sort of thing. All of it remains to be seen at that level, but it's definitely happening out there. You and I have talked a little bit about fasting and like willingly going into a 3-day fast. I don't think any of us willingly wanted to go into a 3-year, like volume fast as far as like availability of work, and just transactions in the market. But it's a reality that we've lived, and we'll see how these currents like converge to, set the environment for 26 and beyond. But I think you make a good point. There are a lot of interesting currents that are kind of coming together at once right now, and will definitely shape what things look like going forward.
Well, Jeff, we did have a jobs report release. We should not take this one for granted because we may not see them every month throughout the end of the year here. But we did get a September jobs report, 119,000 jobs gained. The expectation from Wall Street was 50,000, but we saw a more likely chance for a Fed interest rate cut at the end of December, despite more jobs than expected. Why is that?
Boy, really good question. So it's been interesting because we started, not very long ago, there was like a 90+% chance of a Fed interest rate cut, coming forward. And then with this lack of economic data, and I think uncertainty around, what is actually happening in the market, there was concern that the Fed probably was going to wait until they got data to decide, to make a cut or not. And so, it got as low as it was a 28% expectation of a Fed rate cut, which is now up into the 40% range. Data, and we've talked about this in the past, but certainty and data, lead to more, I think, concrete decisions, more likely to make decisions when there's a certain expectation or kind of a firm handle on what's going on. And so with the government shutdown, the Bureau of Labor Statistics was not producing their reports that they typically produce around, labor market, inflation data. And, so the Fed was certainly relying on other data sources, in the meantime, but I think far less likely to take definitive action until they had, could get some of these kind of staples in terms of data releases, back up and running. Great to see that they are now, but as you said, we're going to lose some of the October data for sure, and the next release is going to be delayed into mid-December for November, jobs data as well. So it's interesting. I don't think that data will actually be out by the time the Fed has their meeting in early December, Mark. So they'll be making a decision before that's even released at this point.
Well, nobody's anticipating it. I do, my bet would be that 2026 is going to be a bit of a stronger year. I was just talking to a colleague that was at the MBA conference and was highlighting that Fannie and Freddie are expecting some, near 25% increase in 2026 or more, where the MBA is essentially assuming something more near flat for 2026. So quite a bit different. And I think, that tells me that you've got a group of MBA, much like appraisers, that are just beat down and hard to get optimistic. They've been optimistic too many times for it not to come to fruition.
Yeah, we've highlighted a number of the false starts. You get a little bit of interest rate relief, you get a little mini boom, and then it peters very quickly. I think that they've lived that too many times, as have appraisers. And great that Fannie and Freddie are projecting, a significant increase, but the people I talk to tend to, be more on the MBS side than the Fannie and Freddie side as far as the 26 projection. Not that we don't
Yeah.
hope for that, but I don't know. I'm putting my money on it.
Yeah, definitely. And I think you got to plan for that to be the case, that there is not an overwhelming improvement. Well, Jeff, the last topic that I had was an article in the Wall Street Journal this past Friday, November 14th. The headline, lower or lender low rate mortgage, bad deal for buyers. This was an interesting one. We've talked a lot about these concessions and what builders are doing, this phenomenon that has really driven the modest amount of sale activity that there has been in the U.S. over the last 2 years has been because of these builder loans, and it's builder affiliated loans that are meeting the market where it needs to be to make the monthly payment for a home accessible, where there isn't that accessibility anywhere else. And so it is buying down rates instead of lowering purchase prices. And generally it's about half as expensive for the builder to buy down the rate versus lower the sale price to accomplish the same monthly payment savings, if that makes sense. So they can get the same monthly payment savings by spending half the amount of money at closing to buy down the rate versus lowering the sale price of the home. And so it's interesting, Jeff, and the quotes within the article were that 18% of D.R. Horton's FHA loans are underwater, made in the last couple of years. Maybe not recently, maybe looking at 23, 24. I'm not exactly sure of the date, but the data for sure. So 18% of D.R. Horton FHA loans were underwater versus 10% of Quicken's loans that did not have those rate buy downs. And I thought it was interesting to know, Jeff, because we've talked so much about it, and it makes sense on some level, at least in this moment in time.
Yeah, it definitely does. And, all of these things, as we've talked about in the past too, tend to be on the demand side. The rate buy down is really an effort to minimize the amount of impact on the overall price, just making the cost of borrowing less expensive to help get the borrower in the home. The problem is that if there are underlying fundamentals or like economic fundamentals that say, hey, the housing price is just too high based on what people can actually pay. You can forestall that a little bit by the builders making more attractive financing options available, but they can't overcome the underlying misalignment in like the fundamental economics if the price is just too much higher than what your average market participant is going to buy. And the builders selling their own inventory can control that. What they can't control is the buyer that's in the home a couple of years that has to turn around and sell and doesn't have that flexibility. We've covered that a little bit too, where they can't compete as well with the resales. If you have too many people that have to or are willing to sell at a lower price than what the builders established or published price is. Now, that said, we're not necessarily seeing values fall off a cliff or dropping dramatically, even if they're softening a little bit. But the reality that 18% are underwater means that the prices have softened at least somewhat from what they paid initially, because we're not talking about the 50-year mortgage like we talked about last week, where they're hardly paying down any principal for a really long time. These certainly aren't interest-only loans. I mean, these are loans where they are paying into the principal a little bit to start with. But it'd be interesting to see where this trend goes, Mark, whether it gets worse and becomes self-perpetuating, or whether these numbers kind of hold at the levels where they're at.
Yeah, I think it is part of the reason why decision makers, those that are making policy decisions from a national level, want 2026 to be gangbuster and come back. I mean, we need it. We don't need the opposite, and interest rates likely will be a fuel for that. Among other things that they could do, the quantitative easing, the printing of money, or buying a bunch of mortgage-backed securities, or other ways they can do it. They're hugely inflationary. I don't think anybody wants that, but I don't know. as we look at like policy and what 2026 is going to be like, it's surprising to see the jobs gains from this September report. I kind of get the sense anecdotally that October would have been a lot worse than that. That's the sense I get, and we'll be a little blind to that, unfortunately. Big unfortunate, I think. So I don't know. It's a messy world out there, and we've been living in a lot of uncertainty that sure needs to get certain as soon as possible.
Amen to that, and I will be very interested in seeing what the November jobs report looks like. It noted it'll be delayed, from the regular schedule, but we'll start to get a little bit better sense of maybe not exactly what happened in October, but where things look, through November. It was interesting, maybe one last note on that point, Mark, was that even though the economy added 119,000 jobs, the unemployment rate still ticked up 0.1% from 4.3 to 4.4%, which just means more people enter the job market we're looking and not finding that, finding jobs as well. So I think your intuition may prove out to be right when we do see November numbers. I'll be very interested to see if that unemployment rate moves materially, once we have that data dropped mid-December.
You bet. You bet. Well, Jeff, it's been another eventful week, and enjoyed the podcast today. A big thank you to all of our listeners out there and the feedback that we get weekly. Really, really appreciate it, and we enjoy doing this, and it's great to see folks out there taking it in and spending their time with us.
Absolutely. And to the diehards that have actually made it through the end of this episode, you get the thank you. Maybe we ought to lead with that next time, Mark, to try to encourage people to stay. But amen to what you said for sure. It's definitely encouraging when we've got people listen, give feedback, shout out. We could probably do this every week to Frank for, providing, so many articles and just perspectives for us to, research and then try to sound quasi-intelligent about, as we talk about them. But, really do appreciate the support and all the people that encourage us to keep going, even though we maybe sometimes ask ourselves why we keep doing what we're doing.
Yeah, very good, Jeff. Well, till episode 67, talk to you soon.
Very good. Thanks, Mark.